People who provide capital to the business are the most important people for that business or for that company. And who are these people? These people fall into two categories. Number one, people who provide equity capital to the company. And number two, people who provide debt capital to the company. So, profitability of a business can also be studied from the perspective of these capital providers. Need not to mention that ultimately a company has to ensure that company's profitability performance from the perspective of these capital providers has to be attractive. And why it has to be attractive? It has to be attractive so that these capital providers are always ready to give more capital to the company so that company is able to implement and execute all the new projects of growth, expansion, diversification, modification, modernization, and things like that. So, what are the ratios that we can calculate for assessing performance of a company or company's profitability from the perspective of capital providers of the company? So basically there are four ratios that you can calculate. The first ratio is earning per share. Let me tell you friends, at this point in time, earning per share is the most critical ratio, the most critical KPI, key performance indicator for any business, every business all over the world. All over the world. Top managements of all companies all over the world, irrespective of geography, are driven by this one number, and that is your earning per share. Let us understand as to why this number, why this earning per share is so critical, so important for the top management of any business. And that is because the bonuses of the top management all over the world are linked with the earning per share of that company. A question may come to your mind as to why bonuses of the top management of all companies all over the world are linked with the earning per share. And the reason is, please understand, you would have noticed as and when earning per share of a company increases, invariably you will see that stock price of that company on the stock exchanges will also increase. Now, what does it mean? It means when the earning price, when the EPS, earning per share, is increasing, as a result of that, the market price of the share of that company is also increasing. What is the consequence? Consequence is when the market price of the company's share is increasing on the stock exchanges, stock markets, automatically by default, wealth of the investors, shareholders, and promoters is also increasing in the same proportion. So when the wealth of the investors, shareholders, promoters increase, automatically they feel happy, and when they feel happy, they give more bonus to the top management. And that is the significance of this one number, which is earning per share. How do we calculate earning per share? It is very simple. So what we do, we take profit after tax or earning after tax or net profit or net income in the numerator, and we divide that number with the number of outstanding shares. And this is how we calculate the earning per share. What the earning per share tells us? It tells us as a company, how much profit are we earning for the shareholders for every share that they have invested in the company. So that is your earning per share. Obviously, higher the better. Second ratio that we can calculate from the perspective of capital providers of the company is CEPS. And what is CEPS? CEPS is cash earning per share. Please remember, it is not enough to earn profit. What is more important is to earn cash profit. So, more the cash profit, more money is available with the company for its expansion, diversification, modification, modernization, debottlenecking, and therefore cash earning per share is even more important than the earning per share. And how do we calculate the cash earning per share? Calculation of cash earning per share, take the figure of profit after tax, add to this figure of profit after tax the amount of depreciation and the amount of amortization. So this is what you will get in the numerator, and divide this combined figure of profit after tax and depreciation and amortization by the number of shares, and you will get your number of shares and you will get your cash earning per share. So once again, more the merrier, more the merrier. And if the cash earning per share or earning per share, if it is increasing year after year, that means it is an indicator that this company is doing extremely well. And that is how you will calculate the EPS and CEPS, cash earning per share. The third ratio that you can calculate from the perspective of capital providers is the return on equity. And how do we calculate return on equity? It is very simple. Profit after tax divided by the equity, which is also known as net worth of the company, right, into 100. So क्या करिए, प्रॉफिट आफ्टर टैक्स को लीजिए और प्रॉफिट आफ्टर टैक्स को डिवाइड करिए बाय द अमाउंट ऑफ इक्विटी which is shareholders capital, or the net worth which is again the shareholders capital. So equity and the net worth are used interchangeably. Multiply it with the 100 and this will give you your return on equity. More the merrier. So जितना रिटर्न ऑन इक्विटी किसी कंपनी का ज़्यादा होगा उस कंपनी के शेयर होल्डर्स उतने ज़्यादा खुश होंगे, बिकॉज जितना रिटर्न ऑन इक्विटी है उतना कंपनी को ज़्यादा, कंपनी के जो शेयर होल्डर्स हैं उनको ज़्यादा कमाई कंपनी दे रही है. तो ये दैट इज रिटर्न ऑन इक्विटी. द फोर्थ रेशियो इज रिटर्न ऑन कैपिटल एम्प्लॉयड. नाउ फ्रेंड्स, I have seen, I have delivered these training programs in more than 50 locations. I have delivered these programs across the globe in Russia, America, Europe, Asia, Middle East, Africa, all over the world. And I have seen this is one ratio which is return on capital employed. It is grossly misunderstood and misinterpreted all over the globe. In 99.99% people that I spoke to about the return on capital employed, they did not have the correct understanding of return on capital employed. Let us have a good understanding of capital employed. For us to be clear about the return on capital employed, we have to be clear as to what is capital employed. We need to understand what is capital employed. So what is capital employed? When I ask this question as to what is capital employed, in my experience, I have seen different people give different answers. But capital employed is very simple. Definition of capital employed is very simple, and I'm sure after today's discussion, you will never have any confusion about the capital employed. So what is capital employed? Very simple. Money that you bring into the business is capital employed. Money that you bring into the business is capital employed. It is as simple as that. And what capital you bring into the business? Again, very simple. What capital you bring into the business? You bring equity into the business and you bring debt into the business. And which debt we are talking about? We are talking about the long-term debt. So what is capital employed? Capital employed is total of equity plus total of long-term debt, and that is what is your capital employed. Very simple definition of capital employed. I am sure all of you will never have any confusion about the definition of capital employed. Now, how to calculate return on capital employed? So return on capital employed, ROCE, how do we calculate it? If we calculate return on capital employed, we take the return in the numerator and we take the capital employed in the denominator and we multiply it with 100, and this gives us the return on capital employed. Now the question is, what do we take in the numerator? So let me ask all of you. So what should we take when you want to calculate the return on capital employed? what will you take in the numerator? Will you take the EBT or EBIT or EAT or EBITDA or something else in the numerator? All of you.
I will take EBITDA.
Okay, you will take EBITDA. Okay.
Either EBITDA or EBIT.
Or EBIT you will take in the numerator for calculating your return on capital employed. Baman sir, what will you take?
Sir, here the taxes
Huh.
are different for every country,
Yes, of course.
every place.
Yes.
So we have to eliminate that word tax.
Uh-huh.
And second is the interest also.
Uh-huh.
But depending on your amount of debt and equality, that on that way it is depending.
Mm-hmm.
So what I feel is that IT if you divide,
Mm-hmm.
then that will be the cash employed. That means that means PAT,
Mm-hmm.
PAT or EBIT.
Hmm.
So tax चला गया, interest चला गया.
Mm-hmm.
So depreciation add हो गया.
Right.
So EBDA.
Hmm.
This is the answer.
Okay, very good. Now, okay, I think I really appreciate the responses from every one of you. Now, let me tell you what will come in the numerator. So, first of all, please understand what ROCE tells you. Return on capital employed आपको क्या बताता है? Return on capital employed आपको बताता है as a business what return are you giving or earning for the people who have given you capital, and that is what is return on capital employed. तो दिस इज व्हाट ROCE टेल्स यू कि एज ए कंपनी जिन लोगों ने आपको कैपिटल दी है उन लोगों को आपने कमा के क्या दिया, व्हाट हैव यू गिवन इन रिटर्न टू देम और व्हाट हैव यू अर्नड फॉर देम. नाउ लेट अस अंडरस्टैंड. So what is my capital employed? My capital employed is the total of equity and debt, right? So that is what is my capital employed. So I will write here, I will substitute capital employed with equity plus debt. And debt, when I say that means long-term debt. What I am calculating? I am calculating return on capital employed. And what my return on capital employed tells me, and I'm repeating it once again for the sake of clarity, return on capital employed tells me as a business what return I am giving to the people who have given me capital. So किन लोगों ने मुझे कैपिटल दिया है? इक्विटी शेयर होल्डर्स ने मुझे कैपिटल दिया है एंड लेंडर्स ने भी मुझे कैपिटल दिया है. इसका मतलब क्या है? इसका मतलब यह है कि न्यूमरेटर में मैं क्या लूंगा? तो न्यूमरेटर में सबसे पहले मैं लूंगा my profit after tax or earning after tax. Why? Because profit after tax is what I have earned for the people who have given me share capital, equity share capital. So पहले मैं क्या करूंगा? पहले मैं profit after tax को लूंगा. उसके बाद में मुझे क्या करना पड़ेगा? उसके बाद में मुझे मालूम पड़ता है कि मुझे lenders भी तो कैपिटल दे रहे हैं ना. तो जिन्होंने मुझे लोन दिया है उनको भी तो मैं कुछ कमा के दे रहा हूं. तो उनको मैं क्या दे रहा हूं कमा के? मैं उनको कमा के दे रहा हूं इंटरेस्ट. सो दिस इज हाउ आई विल कैलकुलेट माय रिटर्न ऑन कैपिटल एम्प्लॉयड. यानी कि क्या? यानी कि मुझे इक्विटी होल्डर्स ने कैपिटल दिया, मुझे लेंडर्स ने कैपिटल दिया. इक्विटी होल्डर्स को मैंने कमा के प्रॉफिट आफ्टर टैक्स दिया और लेंडर्स को मैंने इंटरेस्ट पे कर दिया, तो उनकी जेब में चला गया. तो व्हाट विल कम इन द न्यूमरेटर? प्रॉफिट आफ्टर टैक्स प्लस इंटरेस्ट put together divided by my amount of capital employed, which comprises of the equity and the debt into 100, and this will be my return on capital employed. So this is how you will calculate your return on capital employed. I hope this makes sense to all of you. Does it? Prasanna sir? Bhavan sir?
Yes, sir. Yes, sir, it is okay.
Is it okay, sir? Okay, very good. Bhaman sir, sorry, Prasanna sir?
Yes, sir.
Yeah.
Okay, so this is absolutely clear. So now what we have done, we have looked at the profitability from second perspective, and that is from the perspective of capital providers. That means the people who have given capital to the business, उनके हिसाब से कंपनी की profitability कैसी है.